Is your business financially ready to make an acquisition? An acquisition can accelerate growth, expand your market share, and strengthen your operations. But here's the reality. Too many companies rush into acquisitions unprepared and end up in financial trouble. In this video, I'll show you how to avoid that. My name is Fray, and I'm with PCE Investment Bankers. Today, I'll walk you through how to assess your financial readiness, prepare for the realities of post-acquisition operations, explore financing options, and track your financial health after the deal closes. Let's dive in. Before you commit to an acquisition, you need to evaluate your company's ability to handle both the upfront costs and the ongoing expenses that come with it. Start by reviewing your liquidity, your current cash reserves, and existing debt levels. Ask yourself, can we fund the purchase without putting day-to-day operations at risk? Will we have enough liquidity to handle operational needs and unexpected challenges? Next, factor in additional costs that might not be part of the purchase price. Employee benefit costs. Extending benefits to new employees could significantly increase expenses. Facility leases. Lease renewals or relocations may cost more than what the seller is currently paying. Vehicle and equipment maintenance. Repairs, replacements, or upgrades can add up quickly. Knowing these numbers in advance prevents surprises later. How you structure the deal matters, both financially and legally. You'll typically decide between an asset purchase or a stock purchase. An asset purchase lets you select which assets and liabilities to assume. A stock purchase is often easier to structure, but may transfer more liabilities. This choice has tax and liability implications, so it's critical to understand the impact before you proceed. To learn more about asset versus stock purchases, check out our video. Once the deal closes, you'll likely face new costs before you see the full financial benefits of the acquisition. Integration costs like merging systems, aligning benefits, and restructuring teams can be significant. This is where forecasting comes in. Build post-acquisition financial models that stress test a range of outcomes, including worst-case scenarios. Ask yourself, will this acquisition strain our cash flow? Can we manage the increased debt and still be profitable? Do we have a contingency plan for unexpected disruptions? A strong forecast and a clear safety net are essential for long-term success. Before signing, ask yourself, will this acquisition pay off? Acquisitions should create value, but you need to define what that looks like. Estimate your return on investment by factoring in the purchase price, integration and restructuring costs, and projected revenue gains. Importantly, consider the synergies expected from combining the two businesses, such as eliminating redundancies, securing better pricing under existing contracts, or capturing transportation savings if the acquisition fills a footprint gap. Then calculate the payback period, the time it will take to recoup your investment. Make sure the ROI, including both financial gains and realized synergies, justifies both the cost and the risk before you move forward. There are several ways to fund an acquisition, and each has trade-offs. With debt financing, you retain full ownership, but repayment obligations can put pressure on cash flow. Equity financing reduces your debt burden, but will require that you give up some ownership and control. Mezzanine financing is a combination of debt and equity that balances control with manageable financial risk. Cash on the balance sheet avoids new debt or dilution, but reduces your liquidity and may limit flexibility. The right choice depends on your company's current financial health and long-term strategy. In many cases, businesses use a combination of cash plus one of the other options to strike the right balance between flexibility, cost of capital, and ownership. Once the deal is done, your work isn't over. Keep a close eye on your financial performance and track cash flow, profit margins, and debt levels regularly. Compare your actual results against your original synergy and growth projections, and be ready to adjust your strategy if needed. Remember, success isn't guaranteed at closing. It's earned through discipline and follow-through. Acquisitions can be a powerful way to grow your business, but only if you're financially prepared. By evaluating your readiness, choosing the right financing and structure, and tracking your performance, you set the stage for long-term value creation. At PCE Investment Bankers, we guide companies through every stage of the acquisition process, from preparation to execution, ensuring your position for success. If you're thinking about making an acquisition, let's talk. For more M&A insights and strategies, subscribe to our channel and turn on notifications so you don't miss our next video.